Welcome back to our intermediate financial accounting class. In this segment, we're going to continue on with our discussion of the accounting cycle. Now, up till now, we've talked about the elements of the accounting cycle, we've talked about the accounting equations and how they work and why they work, and we finally, in the last segment, got to start doing some journal entries, actually working on the accounting cycle. Fun stuff. I love doing journal entries. And we've been careful going through our journal entry examples that we've made sure debits and credits are equal, and also that our liability or our assets equal our liabilities plus our equity. We want to make sure that those two equations stay in balance every single time. It's important, it's essential in order to have financial statements and trial balances and everything else that work. Okay? So with that said, we're going to continue doing journal entries. Yes, my favorite part. Here's our next example. Take a second and go ahead and do this journal entry. We're going to keep our pattern going where you can pause and do the journal entry and then come back and we'll talk about it. Okay, did you do it? I hope you really did, because if you're not really doing it, you're not going to get all the value that you could out of this. And besides, journal entries, they're so much fun. You got to take advantage. So, assuming you've tried it, you probably came up with one of two entries. There are actually two options for this one, depending on how you decided to read it. The key term here is the fact that we paid the rent, so we know cash is involved. But where we put it depends. I could have put it in rent expense and paid $6,000. Paid year's rent. Now that journal entry works. Kind of depends. Are you paying at the end of the year or are you paying at the beginning of the year? And we'll do that entry in a second. But just look at this one. Again, assets have to equal liabilities plus equity. We know debits equal credits. Okay? But let's see. Assets drop because cash went out. I debited rent expense, so equity goes down, and I stay in balance. Okay, that's one option. The other option is that you prepaid the year's rent. Let's take a look at that journal entry. In this case, we would debit prepaid, I'm going to abbreviate that, rent. You'll soon learn that no good self-respecting accountant ever writes anything out in longhand. So hopefully you'll be able to follow along both with my bad handwriting and my abbreviations. We could have put it into prepaid rent, because maybe we paid this rent in advance. So in this case, we prepaid year's rent. And now the way to fix the accounting equation differs a little bit. Prepaid rent is a kind of asset. So in this case, our assets went up because we bought a future year's worth of rent, and we'll change it to rent expense later. And then cash went down. So we stayed in balance, and this time it didn't affect anybody. As we use up that prepaid rent, then it will drop equity later. Okay, but that's an adjusting entry. I'm so excited I'm getting ahead of myself. Anyway, but we stay in balance there, okay? Let's take a look at another example. In this case, we purchased a machine, and this time we paid cash for some of the machine and took out a note for the rest. Take a second and do it. All right, I'm going to trust that you really have done it now. Let's do this journal entry. So first thing is we purchased a machine. So there's a machine coming in. So that's an asset, would be a debit because we're getting a machine. So you could call this equipment. You could call it machine. You could call it PP&E. That would be fine too, although PP&E, property, plant, and equipment, usually a general title as opposed to an account, but it still works. So that's going to be a debit, and it was $30,000 overall that we paid for this. Now let's see. $10,000 we paid, so that would be cash going out. And then we created this note payable. So notes payable for the rest, so $20,000. Okay, this is to purchase equipment with cash and a note, and I would probably, this is one of those places where I would include a little more detail. I would probably call this, it's a 6%, X number of months or years, ... all the other information about my note, because I'd want to be able to come back and reference that later. One of the questions I often get at this point is, what about interest expense? Don't we have to record that? I mean, they're being charged interest. Well, we don't have to record interest expense now, because interest expense accrues over time. So on the day I took out the note, I don't owe the bank any interest at all, so I don't have to record it. As time goes on and that interest starts to build up, then I'll record it. But for now, we don't have to worry about it. We're just going to make a note in our notes to our journal entry that there is interest accruing that we'll have to keep track of later. Okay, again, we know our debits and our credits are equal. Let's take a look at our accounting equation. Assets equals liabilities plus equity. In this case, assets go up. I debited equipment or machinery or PP&E for $30,000. Okay, then what happens? Well, I credit cash for $10,000, so that drops. And then I credit notes payable. Notes payable is a liability. And let's see, credit to liability increases it, right? So that's going to bring it up, and I stay in balance. In this case, we had some play in both of them. Some, I was trading my assets for about $10,000, and then I took out a liability for the rest. And that gave me the financing that I needed to pay for that asset. Isn't this fun? I love this. Let's do another one. In this case, we purchased $25,000 worth of merchandise on account for terms of 210 net 30. If you're not familiar with these terms, it means that you get a 2% discount if you pay within 10 days, or you owe the net amount within 30. And then after that, they'd probably start charging you interest. So let's take a look at this journal entry. Again, take a second and try it, and then we'll talk about it together. In this case, we're getting inventory. So we're going to debit our inventory account for $25,000. But I didn't pay for it, not in cash. Instead, I bought it on account, which means I'm going to owe them that money later. So it's a debt, cleverly called accounts payable, because it's an account with a vendor that I have to pay later. Don't you love these clever accounting names? They're all so clever. Rent expense. We paid for advertising. Oh, advertising expense. That'll work. People owe me money. Accounts receivable. I owe them money. Accounts payable. It's just we came up with clever names, didn't we? The accounts payable credit $25,000, and we're going to make a note. We're going to purchase inventory on account terms 210 net 30. And we'll keep track of that so that we can try to pay in time and get that 2% discount if we have the cash for it. Again, let's take a look at our accounting equation. Assets equals liabilities plus equity. In this case, assets go up, $25,000 with that debit to inventory. And then I didn't pay out any assets for it, but I now owe that vendor. So I've got a liability to that vendor, $25,000, and I stay in balance. Let's take a look at another one. We paid for the merchandise on day 10. Take a minute, give it a try, and then come back and see it. In this case, we paid for that merchandise, so we're getting rid of that accounts payable, $25,000. And we paid cash, but I didn't have to pay $25,000 in cash because I got that discount. So let's see, $25,000. And you can do this a couple of ways. The easiest way is to multiply by 1 minus the 2%. So this becomes 25,000 times 0.98, 24,500. So that's the actual cash that I'm paying out. I don't balance. I'm not balanced. I can't do that. I've got to balance. So what do I do to make it balance? Well, I know I need to credit something for 500, but what? Well, again, clever accounting names. In a lot of cases, we call this purchases discounts because I got a discount on a purchase. Or I might put it into inventory. Which one to use depends on my inventory system. Purchase discounts is from what we call a periodic system, which we'll talk about later. Inventory is from what we call a perpetual system. And this is paid for merchandise with discount. Or in discount period would work. A lot of things would work. We don't need anything special. Let's take a look at this. Okay, accounts payable goes down $25,000. So liabilities drop. So liabilities plus equity drops. We paid cash $24,500. So that drops. Okay, but now that doesn't balance. We know the debits and the credits balanced. So what do we need to change here? Well, whether you use purchase discounts or inventory, eventually it's going to flow through to inventory. Perpetual puts it directly there. Periodic system gets there later, but it drops the value of that inventory, and I stay in balance. Okay? All right, let's do another entry. Oh boy, these just get so fun, don't they, as we add more details. In this case, we're going to take a look at a sale that we made. So we sold $15,000 of inventory, that's what we paid for it, for $25,000. Our terms are $310, net 30. Go ahead, give it a try. This one is pretty straightforward. We're going to debit accounts receivable for $25,000 because that's what they owe us. And we're going to record sales revenue for $25,000. Now, if this is a periodic inventory system, we're going to stop there. If it's perpetual, we're going to go on. We're going to record cost of goods sold for $15,000. That's an expense account. You could also call this inventory expense. Nobody does, but that's technically what it is. And then we're going to credit inventory. What you don't want to do is debit accounts receivable, credit inventory, and then credit profit for $10,000. We don't keep track of profit here. We keep track of the revenues and the expenses for now, and we calculate profit when we do an income statement a couple steps later in our accounting cycle. So this is the sale of merchandise on account. And if you don't always offer these same terms, then you put the terms in here. If it's a constant, then you don't worry about it. But we'll go ahead and put it in for now. Let's take a look. What happens? Well, let's see. Accounts receivable goes up. That's an asset. They're going to pay us later, $25,000. Sales revenue goes up. That's equity, so that goes up by $25,000. Cost of goods sold goes up. It's got a debit, and it's an expense. It gets bigger, but when it gets bigger, equity drops. So equity drops by $15,000, and then inventory drops $15,000, and I stay in balance. Okay? Every one of these entries, it happens every time. It's great. Okay? If you get to the point where it doesn't balance, you know you did something wrong, and you need to go back and try again. We've done a lot of entries now. We're going to stop, and we'll come back later and continue on with our discussion. We've got just a few more journal entries left to do. Shoot, we're running out. That's okay. We'll do more later. And then we'll go on and talk a little bit more about the rest of the accounting cycle. I'll see you then.